Okay, guys, rules of engagement. If you are not talking, please keep yourself muted, okay? And then unmute yourself if you need to ask any questions. All right. Let me share my screen and let's get going. All right, guys, you're able to see my screen, correct? Just let me know so we can start. Hello.
Yeah, you can see your screen, yeah.
Perfect.
I can see your screen, sir. Yes, sir.
Lovely. All right, I'm going to start off with a quote that makes so much sense in terms of what we're dealing with tomorrow and overall what we've been trying to work towards. Last time we were together, we did a technical analysis session. Today, we're going to deal specifically with fundamentals. To be specific, non-farm payroll, which is employment data, the most crucial data that we have in as far as the current context of the Federal Reserve Bank and interest rates are concerned. All right, so you'll notice I've got a screenshot and I've got a quote that kind of ties it all together. So I want you guys to understand that economic events shape the direction of the trend, okay? And when we can understand technical analysis properly and apply it in line with price action, then we can almost predict or trade economic events much better than without having both technical analysis and fundamental analysis. So I just want to show you guys the screenshot that I've got here is for gold, okay? It was for NFP, I think late last year, okay? So this is the setup that I had going into NFP. The day before NFP, this was the current structure. You can see the market was making lower lows, lower highs, lower lows, lower highs, lower lows. Now, we combine the fact that I'm in a downtrend. If we can combine it with our entry criteria that we discussed, we need to see a downtrend, and we're seeing it in the form of a descending channel. This is a potential reversal setup, okay? But it is only confirmed after creating a new high. And you can see a new high was created there. We had a break of structure over there. A new high above that previous lower high, and an impulsive break of structure, which gives us our phase one. Are you guys following me? Remember we said that the market moves in impulsive phases and corrective phases before completing the move. We always have that 1, 2, 3. This is 1. The move going down, which is temporary, is 2. The impulsive wave is 3. Are we all on the same page in this regard? You remember the conversations we had about this? If not, it's okay. We're still going to have it again and again and again and again. I'm always going to be repeating the foundational principles of how the market moves. It moves in this 1, 2, 3 pattern. So I want to show you that this pattern corresponds with the NFP data that came out on the day. All right, you guys can unmute yourself and give me some comments based on what I'm saying. Any questions so far? Do you follow what I'm saying? Does it make sense?
Yes, sir. I follow you.
100%. All right, now I want to map out to you.
Question.
Yes.
What significance does the time frame play? Like, yeah, the time frame.
So the time frame, the 5-minute time frame is significant because in the context of price action, we want to see price move. We want to see the behavior of the price before we get the confirmation. So the confirmation, the time frame helps us to identify this trade setup before everyone else is aware of it on the higher time frame. Because on the higher time frame, the confirmation is here. Once price breaks above this high, that's when most traders took this trade, okay? But because of our time frame that we're using, we got to see, number one, that extended W pattern. What do we have here? Got a double bottom. What's this? Remember we discussed this? There's the perfect buy opportunity right there, just below that double bottom. Does this look familiar to the previous technical analysis sessions that we had? Or does it look like new information? If you did the homework that I asked you to do, and you went through the lesson that we went through, I think sometime last week when we did technical analysis, and we discussed the fact that there's something we call entry cheese. There will always be a double bottom or price action pattern that will induce people to take up buy positions in this area over here, with their stop losses in this area. That price action takes out their stop losses, and that's our alert to be a buyer in the market, okay? Ideally, we want to be a buyer here. Take up a risk entry, stop loss beneath the low. Stop loss beneath the low. Here's our first confirmation, break of structure. We broke through the trend line. Second confirmation, we broke above this high over here. See that? We've broken above that high. Third confirmation, we've made a new high. Fourth confirmation, we have a new higher low. Fifth confirmation, this is phase 2 of the 1, 2, 3. What's this? That's phase 3. It's this impulsive move to the upside. Can you guys see it? And look how it left. There was so much momentum in this buy that it left a big gap. Can you see? There's a huge gap, and price started forming above the area. Can you guys see that?
Yes, sir.
Yes.
Question, Mr. Wise.
Yeah, go for it.
Yeah, I just wanted to double check something with you. So if we take we place the trade just here on the initial, just underneath the double bottom.
Yes, I see.
When it makes this big gap, I
Yes.
agree. We're taking a buy there. It's going high. As it makes this big gap, we are still in the trade. I guess.
Yes. So this gap,
because,
the price went this. This is what's happening here. It's just that it moved so quickly that it left a big gap, confirming. That's how high impact the news is. Like NFP tomorrow, guys, we could find behavior like this. The market moves so quickly. By the time the news comes out, it's already too late. That's why we need to enter our trade at least 20 minutes, 30 minutes before, which is somewhere in this area. If you count back all these candles, now, for every candle here, guys, it's 5 minutes. Every candle you are seeing here. So you can see the amount of time. And here is at least an hour for that to develop. So the opportunity was taken the day before. This happened the day before. This is on the day, NFP. So the opportunity on the day was here. We could have left all of this alone if you missed the break of structure and this trade over here. There was an opportunity to take a buy position at these levels here, at the bottom of phase 2, because phase 1 showed itself. There's phase 1 over there, the movement going up like that. That's phase 1. We do this. We have phase 1 right there. Boom. That's phase 1 where the market goes up. Phase 2 is this. The temporary counter trend move. It's this. Phase 3, boom, up. And that's how market structure works. That's what we've been discussing. So the opportunity is down here. If you had missed this one and the break of structure here.
Mr. Wise.
Yes, sir.
I just there where you are now. I just wanted to know, because please pardon me for my slowness. Are we able to place an order prior to this entire movement, and catch it just where it begins here on below the double bottom, so that when it goes up until our take profit, we are not late. Like there was a day we were late to enter the market because.
So we can leave pending orders. We can leave pending orders. So while the market is doing this, once we've gotten this double bottom over here, and we see price coming into the zone, we can leave a pending order, a buy stop. So we're not instant execution, a buy stop above this area, so that once price breaks here, automatically you're triggered in. That's an option as well.
Audio recording test. Audio recording test.
That's an option as well.
No, No, thank you. If there's something like that, then I would want to opt for that because I don't want to miss it this time around.
Okay, no stress. I'll show you how to do that. Okay. Okay. So let's
my
start,
king.
guys.
So
Yes.
can I just confirm, my king?
Yes.
So phase one is like a pole,
Yes. Beautiful. There we go.
which is a bullish
Pole.
flag.
Yes. This is a bull flag. That's perfect, bro. You got it. You got it. This is a bull flag. If you went through the exercise that we went through last time, this is the name of that patch. It looks like a flag pole. You see, we have a pole and there's the flag. The flag makes itself sort of like a square. That looks like a flag. Then the completion, we want to be a buyer here for the market to go up, and we get that phase three. If we missed out on buying either here or at the break of structure here, we should be represented by this trend line breaking over here, or this previous lower high breaking over here. So there's three opportunities. 1, 2, 3. And a fourth one at the break of this level here. So there's 4 opportunities to take up a trade when we get this type of behavior. Do you guys understand? It may look different. I mean, phase 2 might not always look like a flag. So it might look like this. It might look like that, but it's the same thing. The opportunity, 1, 2, 3, and we have one here at the break of structure. Same thing. It's just that this pattern allows for less of a profit because it went deeper. So you have to be taking it around these levels here when we get a confirmation above that previous lower high in phase 2. You understand? You got me on that one.
Oh, I get you, sir.
Perfect. Perfecto. All right, let's move. Our time is limited today. All right, so I want to discuss what NFP. Guys, can someone mute themselves? Someone hasn't muted themselves. Please mute yourself. Thank you. So, guys, we need to understand what is NFP. All right, okay, I'll mute you on my side. I think you're not hearing me. There we go. Cool. So NFP, guys, is a term that we use. I mean, it's data that is used to find out how many new jobs were added in the US economy, particularly the US, all right? Number of paid employees, all right? And it excludes certain sectors. It excludes farm workers, it excludes private household employees, that's our auntie at home. It includes non-profit employees, all right? And it is used as an important economic indicator, keyword, because it reflects the overall health of the US economy. The easiest way to judge how productive a country is to check the employment rate. It's as simple as that. The more people are employed, the more people are earning a salary. The more people are earning a salary, the more people are spending that salary in the economy. The more people are spending the salary in the economy, the higher the GDP. The higher the GDP, the higher the currency value. It's a simple equation. All right, let's move on. So the data is collected by an institution called the BLS, Bureau of Labor Statistics, and we see this data once a month. It's a cyclical report once a month, okay? And it includes the number of jobs created during that month. It'll give us the unemployment rate, which is currently sitting around 3.7%, and other key labor market indicators such as average hourly earnings. Are average hourly earnings going up? Are they going down? How much are people earning per hour? Those kind of figures are very important, okay? In simple terms, though, it'll help us understand the strength of the economy. The more people are working, the more people are spending. Simple as that. And the stronger the economy is likely to be, all right? So the report itself is used by people like us to determine whether the financial asset that we are trading is going to be stronger based on this data, or is it going to be weaker? It's also used not just by traders, by policymakers, particularly the Fed, all right, the Reserve Bank, to try and determine the appropriate monetary policy based on the labor market, okay, and based on what they are trying to achieve. Now, it's important to understand that what they are trying to achieve determines what impact high numbers or low numbers have for that financial asset, okay? Because ultimately NFP will determine the interest rate because it affects inflation, okay? So in terms of how it influences monetary policy, all right, let's talk about that, what I just introduced. The Fed will use it to assess the health of the economy and to determine the appropriate level of monetary policy, all right? And they do that so that they can maintain the purchasing power of the currency and to keep inflation at acceptable levels. So now let's talk about inflation, guys. All right, so here's how it works. If we have high jobs numbers, if a lot of people are employed, it can cause inflation, okay? Because the more people are employed, the more people are spending their money. If too many people are spending, if too many people have a high demand for goods and services at the exact same time, it creates inflation. Look what happened during lockdown. Alcohol stores were closed. Everybody had a high demand for alcohol, but it was limited in supply. What happened to the price of alcohol? It went up. Guys. You all know alcohol was extremely overpriced. It was inflated during lockdown because there was a high demand and low supply, all right? So the same thing happens in the economy. If there's too many jobs being created and people are spending and there's a lot of consumer demand for goods and services and there's an inability to supply, it will create an inflation of the price of those goods and services. But higher inflation equals higher interest rates, okay? Because the way to bring down inflation is to bring up interest rates, okay? So you see how the equation leads to this. The higher the interest rate, the stronger the dollar. Do you see what we're working with, guys?
Okay, sorry to disrupt. No?
Yes.
Would say high inflation, high interest rates.
Yes. So that's the way it works. When interest rates are high, when inflation is high, the way the government, the way the Federal Reserve can, there's two options, guys. Okay, so let's take the lockdown scenario. I said an easy way to understand inflation is to go back to lockdown, okay? The price of alcohol went up because there was a lot of demand for alcohol during lockdown. However, because the bottle stores and the alcohol distributors were closed, it meant that there was a limited supply. And therefore, because of the high demand and limited supply, anybody who had alcohol or access to selling it had a right to sell it at whatever price they wanted. They knew they could take up the price because people are willing to pay for it because they can't find it anywhere. Do you understand that? I need at least us to be on the same page with that. You need to understand what inflation is. That's inflation. When the price of something goes up because there's a high demand for it and it is low in supply, okay? That creates inflation, okay? Now, when inflation is high, the way to normalize the price is to do either one of two things, okay? In the case of lockdown, what made the price of alcohol stabilize again? I need someone to answer me quickly. What made the price of alcohol to go down again? Someone, anyone, quickly. It's not rocket science, guys. It's an easy one. Prices went up for alcohol during lockdown because the demand was high and the supply was low. But those prices didn't stay high forever. What made them go down? Come on, guys. Come on, come on. The price of alcohol went down because the stores reopened. All right.
They reopened, so supply was there again.
Thank you. Thank you.
Yes, sir.
Thank you, guys. Come on,
Sorry,
guys.
man.
Participate, guys.
I muted myself and I was answering. Sorry about that.
Yes. So it's either you can affect the supply, okay, to restabilize the price, or you can affect the demand, okay? So with alcohol, it was easy. The supply was restabilized and it made prices restabilize, okay? But with the overall economy, it's not easy to work with supply side dynamics because the Reserve Bank cannot influence the individual businesses, okay? It's too many moving parts. So the easiest way is to affect the consumer directly, affect the demand. How do you bring down? So you need to bring down the demand to match the supply or bring up the supply to meet the demand. In the case of the Reserve Bank, they want to affect the demand to meet the supply. So they need to bring demand down. They need to stop people from wanting to spend money on the things they want to spend. How do they do that? They increase interest rates, okay? By increasing interest rates, we increase the cost of accessing capital. So think about it this way, guys. If you want to open a business, all right, and you take a business loan to do it, let's say you borrow 100K to start a business, and the repayment for that loan is 5K a month, okay, at the bank. Every time interest rates go up, your loan is going to go up. It might go from 5K to 5.5, from 5.5 to 6K. So if that is happening, do you think that you are going to take on new employees? Are you going to hire more people under those current conditions? Are people going to be encouraged to start businesses knowing that last year, if I'd taken this loan, I would have paid 5K. If I'm taking that loan this year, I'm paying 7K because of the high interest rate. Are you still going to start that business and employ 10 people? No, you're going to wait. Am I correct?
Yes, sir.
What does that do? That means that by stopping me from taking that loan to go and start that business, they've stopped 10 people from getting a job through me. Now, how many other business owners are making that? If you multiply that on a larger scale, that's how you slow down the economy. That's how you bring down the demand for goods and services. You need to affect business owners, number one. They need to stop hiring new people. And then ultimately, once you hold interest rates there for long enough at that high level, eventually it'll stop people from hiring new employees, but it'll also get some people laid off. If I'm a business owner and now my overheads are now higher because of the higher interest rate, because of the debt that I have to now reservice, that means that I might let go of one employee. Correct? So that I can be able to sustain my business. Do you see that? Me letting go of that employee means that that person is now not spending their money in the economy. What is happening to the demand? It is coming down. So that's how you deal with inflation. Does that make sense? Can I move on?
Yes, sir.
Proper. So if the NFP data suggests that the labor market is strong, meaning more jobs were added, that means the economy is growing and the Federal Reserve might consider tightening their monetary policy. Tightening monetary policy means increasing interest rates. Look at this image, this graphic that I just put up here. I think it's a perfect image. Here's the Fed. Here's the Fed. That's Jerome Powell and other guys. And this is the guy that controls the interest rates. They tell this guy, okay, if inflation is increasing, open up the interest rates, take them up higher. If inflation is decreasing, lower the interest rates to stimulate the economy. So this is how monetary policy works, guys. Let's say these are zero interest rates, and interest rates right now are sitting at 5%, 5.5% in the US. When the Fed wants to stimulate the economy, they will have interest rates near zero. And then the economy will get stimulated, and then obviously inflation will come in. At these high levels, when inflation is up, they decrease interest rates, and then economic activity comes down. So it will ebb and flow through low interest rates and high interest rates. If they want to stimulate the economy, they will have lower interest rates. If they want to bring down economic growth, higher interest rates do that. Okay. Now let's move on. So to prevent inflation from rising too quickly, it could mean the Fed will raise interest rates. Okay. With the end goal of lowering consumer demand. There's the key word. Lowering consumer demand to meet the current level of supply in the economy. Exactly as I said. Right, on the other hand, though, if NFP data suggests that the labor market is weak, then the Fed may consider loosening monetary policy to stimulate economic growth, and that could mean lowering interest rates, okay, with the net effect of influencing consumer spending. So in an environment where there are low interest rates, cash is cheap, loans are cheap. That's an environment that facilitates people buying cars, buying houses, because people don't buy cars or houses based on the overall amount. They don't look at a car and say, this car cost me 3 million, I'm not going to buy it. No, they look at the car costs 3 million. What is my affordability? They look at the monthly installment. That's why interest rates are so important, because the interest rate determines the monthly installment, and the monthly installment will determine whether the consumer has a demand for that thing or not. I cannot break it down any easier than this, guys. This is a powerful session if you are getting it, okay? Because if you can understand interest rates and what affects interest rates, then you know how to trade NFP, you know how to trade CPI, you know how to trade retail sales, you know how to trade PPI, you know how to trade initial jobless claims. All of the data that we look at during the course of the month leads up to the decision made on the interest rate, gentlemen. Okay, overall though, NFP is an important input into the Fed's decision-making process because it'll give them a crucial outlook into the health of the labor market. And then they can decide what to do with the interest rate by assessing the labor market and where inflation is. If the labor market is growing in an environment where inflation is low, that's great for the dollar. It's amazing for the dollar. But if the labor market is growing and giving us high NFP in an environment where inflation is high and the Fed is trying to bring it down, that will be negative for the dollar. Okay? Right, there's about 10 minutes left. So I'm going to skip through this part. No, I'm going to skip this part. So high interest rates will have an impact on the following sectors, okay? It'll affect consumption and investment, okay? When interest rates are low, borrowing becomes cheaper and people tend to spend and invest more, which will stimulate the economy, right? On the other hand, when they're high, borrowing becomes expensive, which will reduce consumer spending and business investment and will lead to a slowdown in economic growth, leading to a weaker dollar. And that's when we buy risk assets. That's when we buy GBP USD. That's when we buy NASDAQ. That's when we buy Dow Jones. We buy Euro USD. That's when the dollar's stronger. Okay? High interest rates will affect inflation. The higher the interest rate, the more inflation will be subdued because it will reduce consumer spending, business spending as well. Okay? While lower interest rates will increase inflation because they will stimulate spending. Okay? Also, currency value. When interest rates are high, it makes the currency of that country attractive to have. Okay? Think about it this way. As a US citizen, the best interest rate I can get is 5.5%. But in SA, the interest rate is almost 9%. Okay? So if I'm a high net worth individual and I'm looking to gain exposure to higher interest rates, then I'm going to be attracted to having rands. So I might convert $1 million into rands, put them in an FNB account for 12 months, gain the 9% interest rate instead of the 5.5, and then bring back my money into the US in dollars. Do you see how that affects people's demand to have the different currencies? Yes, no, maybe?
No, I see.
Beautiful. All right. Conversely, when a country's interest rates are lower, it tends to depreciate the currency value because it makes having that currency less attractive for people who want exposure to your interest rate. All right. It also affects employment, okay? So when interest rates are low, businesses will borrow more and invest in expansion, which might mean them creating new jobs, okay? Which is good for the economy, positive for the dollar. When interest rates are low, when interest rates are high, businesses will reduce borrowing and investment, which will lead to job losses, which is what the Fed wants to see right now, okay? The Fed wants to see NFP trend lower. They want to see CPI or inflation trend lower so that they can begin cutting their interest rates to stimulate the economy. That's what they want to see. So the dollar needs to weaken a little bit in order for the economy to be fixed, to bring inflation down to 2%. Right now, inflation is sitting above 3% at 3.2%, between 3.2 and 3.4. So there's still some work to be done. Okay. Overall, though, they play a significant part in shaping the strength of the US economy. Interest rates are really important, guys. They're the end all and be all. Everything we trade is linked to interest rates. Okay. Now, it's not easy to predict the exact effect that NFP might have, okay, on the chart, because it depends on the market expectations. So current market expectations, NFP is 190. There's 190,000 jobs to be created tomorrow. Okay, that's what the market wants to see. Global economic conditions, inflation is sitting at 2%. The Fed wants to get it. No, inflation needs to be at 2%. Right now, it's sitting at 3.2. So there's the conditions we need to get to here. A lot of work needs to be done. So for this number to get to 2%, this is very important. this cannot be too high. Because if this is too high, it's going to take longer for this figure to get to here. Okay. Geopolitical events are also very important. Okay. In general, though, better than expected NFP report is going to strengthen the dollar, guys. Because what's going to happen is tomorrow, if we get a figure that's above 190 and we get like 250, that's going to be stronger for the dollar, because then what is the Fed going to do? The Fed is going to look at this number and be like, okay, jobs are still high, meaning people are still spending money in the economy, meaning the 3.2% is going to take longer to get down to 2%. What are they going to do? Interest rates are going to be held longer, are going to be held higher at 5.5% for longer. They're going to take a bit longer to start cutting interest rates, which will make the dollar go up and will make us sell on NASDAQ, GBP USD, Euro USD, gold. Okay, a figure lower. Let me get to, we're almost done, guys. 4 minutes left. Weaker than expected NFP data will weaken the dollar because it's going to suggest slower job growth and a weaker economy, which is what the Fed wants to see so that they can lower their interest rates. Interest rates are too high right now. People, consumers are crying. Businesses are falling. People are losing their jobs. So they want a reason to bring the interest rate down. And that reason is going to first start tomorrow. Can we get a lower NFP? If we get a lower NFP, it could mean a lower CPI next month. If we get a lower CPI next month, then definitely interest rates are coming down in June. And if interest rates are coming down in June, it's going to make investors sell off US assets, leading to a weaker dollar. Okay? Leading to a weaker dollar. And a weaker dollar means buy on any other asset that we are looking at. All right, guys? So before I close today's session, let's look at the DXY. Okay, let's look at the DXY real quick. There's DXY here. Can you guys see the dollar index here? Please confirm.
Yes, sir.
Okay, let's do some technical analysis. So if NFP comes out higher, you'll find that the dollar might come down to the psychological level here, where we have that resistance, and then revisit these areas up here. All right? Could visit these highs. So we'll get supported by that level. If we get a higher jobs number, the dollar will appreciate and come back to revisit these levels, either to break above or likely a retest. Because we are finally, gentlemen, we finally have a breakout on this uptrend. We had a break of structure there, right? It was either there or you can even move it to here. But clearly, we've exited this uptrend, and now the market is likely to start a downtrend. So we've got a new low that has already been created. Can you guys see that? This was our line in the sand. All right, we've broken out of that. A new low has been created. We created a lower low. Now we need to create a lower high, and the lower high is still here. This is the previous lower high before we create a new low. So I think if NFP gives us a high reading, this is the behavior we could see. If it gives us a low reading, then I think we'll get a slight pullback to this level, and then we'll just sell off anyway. Okay, but I'm seeing dollar weakness if we get a lower number, and I'm seeing dollar strength if we get a higher number. Okay, and as far as NASDAQ is concerned, let's have a look at just NASDAQ, just one chart besides the dollar index, so we can just put that into perspective. We've been on an uptrend on NASDAQ, guys, okay? As you can see, in terms of technical analysis, we've been supporting this uptrend over here with these points in the chart, okay? So I think that if we get a higher jobs number, NASDAQ will drop down to these levels, meeting this trend line over here and also meeting this trend line over here for a buy to go to the upside. Okay, that's if the figures are, if the figures give us a lower jobs number, we'll definitely break up above there. If we get a high jobs number, I think move will still come down, exacerbate, and maybe come down to here to meet this low over here. We get a higher jobs number, NASDAQ is going to fall even more before recovering. Okay, but it will recover depending on how much of a difference there is between the 190 and the actual figure. All right, guys, and I've got less than 60 seconds left, so I'm going to